As you know, I wrote a memo called Sea Change in December of 22, and it has really been central to all of our activities since then, because interest rates are so central in everything we do. And I've been thinking lately that interest rates are kind of like the weather. The weather determines what we'll wear, where we'll go, what activities we can conduct, whether we stay indoors or outdoors. It just changes. It dominates our life in a kind of unspoken and unrecognized way. Similarly, interest rates are the climate of investing in finance and business and the economy, and they determine or influence everything that goes on in a material way. And when they change significantly, the environment for activity changes, and consequently, all the activities change. And, I followed up Sea Change, December of 22, with a memo called Further Thoughts on Sea Change, May of 23. But I said in there that largely thanks to highly accommodative monetary policy, we went through unusually easy times in a number of important regards over a prolonged period of time, but that's over. I said in the Sea Change memo that in 1980 I had a personal loan outstanding from a bank, and I got a slip in the mail that said the rate on your loan is now 22 1/4. 40 years later, I was able to borrow, again personally, at 2 1/4, fixed for 15 years. Now, hopefully, I was in improving credit over that period of time. But you can see from this chart that the Fed funds rate did the same thing. It went from 20 in 1980 to 0 for much of the last 15 years. Again, a decline of 2,000 basis points. And I believe that that 2,000 basis point decline was the most important single event in the financial and business world in the last half century. Declining interest rates have very significant effects. They stimulate the economy. They increase consumer demand. They make most businesses more profitable. They make assets more valuable. They reduce the cost of capital and make financing more readily accessible and, of course, cheaper. And they make default and bankruptcy less likely. I have compared the declining interest rates of this period to a moving walkway. And you get on and you walk at your normal pace, you make terrific progress, and you say, boy, I'm really fit. Similarly, people buy assets, maybe they buy them with borrowed money, they get great net results, and they say, boy, I'm smart. But in both cases, we have a lot of help. And the declining interest rates were a moving walkway, a tailwind, if you will, behind investors for a long period of time. Now, Easy Money described some of the problematic side effects of low rates, and they're worth noting too. They reduce the perceived opportunity cost. You don't have to give up much to borrow money or to make an investment. And so they lower the bar. They encourage risk-taking because the returns on safe investments are suddenly low. People go out the risk curve to get the returns they want or need, potentially into unwise investments. They enable deals to be financed readily and cheaply. They encourage greater use of leverage, and that increases the fragility of companies and properties, as we're seeing now. And it induces optimistic behavior that lays the groundwork for the next crisis. When I wrote Easy Money, I talked about having read a book, The Price of Time, by Edward Chancellor, and he quotes the Manchester, England banker John Mills. And I thought that in 1865, this comment was incredible, and I'm glad to highlight it for you. We think of panics as producing losses, and panics as making things fall apart. But Mill said, as a rule, panics do not destroy capital. They merely reveal the extent to which it has previously been destroyed by its betrayal into hopelessly unproductive works. The problem is not what happens at the lows. The problem is what is done at the highs, which then are disclosed at the lows. Now, when something is the case for a long time, people believe it's normal. And that's especially true in the investment business. When we have something in the environment for 5, 10 years late, people think that's normalcy, and that's the way it's always going to be. Anyone who came into this business since 1980 had, until 42 years later, essentially seen only declining interest rates or ultra-low interest rates or both. In 21, of course, we saw inflation in the green line reached a high of roughly 9. The Fed decided eventually in late 21 that it had to respond, began to do so in the first quarter of 22. That's the black line, and you can see the Fed funds rate went from 0 to 5.5, where it is today, and that made the green line start bending down, and it has come down quite well. So I think that within 2 or 3 years, the Fed funds rate is likely to be in the 3s and to settle there for the subsequent years. Lower than today's 5.25, 5.5, but well above the 0.5% average that prevailed between 09 and 21. I resist the term higher for longer because I don't think of rates today as being higher. These are not high rates, these are normal rates. But nevertheless, they're a lot higher than what we lived through in the last 15 years. So the bottom line is that after a long period in which everything was unusually easy in the world of business, finance, and investing, I think something to normalcy appears to be setting in. And as a consequence, I believe economic growth may be slower, profit margins may be lower, investor psychology may not be as uniformly positive, ownership interest may not appreciate as reliably, the cost of borrowing will not trend down consistently. Leverage is unlikely to add as much to results as it did in the period of declining rates. Businesses may not find it as easy or as inexpensive to obtain financing, and default rates may head higher. In terms of conclusions, Einstein said that insanity is doing the same thing over and over and expecting a different result. I think another version of insanity is doing the same thing in a different environment and expecting the same result. So if the environment for business and investing is so thoroughly different in the coming 5 or 10 years as it has been in the last 15 to 40 years, I think it's folly to expect the same results. The investment environment and the starting point has a huge impact on the success of specific strategies. I believe strongly that the strategies that produce superior performance in the period of declining and ultra-low rates may not be the ones that do so in the years ahead, or certainly not to the same extent. So the point is that lending or credit or fixed income investing, whatever you want to call it, may be better off today than equity investing. Liquid credit instruments offer yields in the high single digits. The yields on private credit are in the double digits. These yields, number one, are highly competitive with the excellent historical returns on equities. These yields exceed most investors' required returns, and these yields are much less uncertain than the returns on equity and other ownership strategies. They have a high probability of delivering what they promise. I kind of summed up in Sea Change by saying that investors can now potentially get solid returns from credit instruments, meaning they no longer have to rely as heavily on riskier investments to achieve their overall return targets. So the economist Paul Samuelson, who wrote the textbook that many of us read in college, said, "When events change, I change my mind. What do you do?" I believe that events have changed. The environment has changed, the climate for investing. And what will you do about it? Or to play devil's advocate, what could be the reason for not taking significant action in response to the change in the climate? I hope that it sets the stage for what we're going to talk about today.